Well, welcome back to Finance Uncut. On today's episode, silver $300, gold $10,000, and a stock market crash. Hey guys, before we get to this video, I just wanted to say that I recorded this video on Friday, just before we got the news about the LBMA and the bullion banks being exempt from the Basel III rules in the UK. So later in this video, I actually talk about gold and silver and Basel III and how I've got a Basel III update video coming out, which I will put out in a couple of days. And I will share some of the information that I have already recorded for that video, as well as now we've got this new information. I will share my thoughts on that and what that means for gold and silver. It is disappointing, which you'll see in the video that I release in a couple of days' time. However, just wanted to let you guys know that when I recorded this, it was on Friday beforehand. So later in the video, I talk about it. Anyway, with that, enjoy the video.
I'll just talk gold first. Gold had a great run from 2001 to 2011. It ran up from $250 an ounce to $1,900 plus. And since then, we spent, all the time up until a couple of years ago in consolidation. So there was a very long consolidation. It broke out of that consolidation. Can't remember where it came out, but it was down, 1,200 or thereabouts, and ran up to 2,100, and then corrected all the way back down, and not all the way back down there, but came out of the March 2020 lows at 1460. So we're on our way in terms of move from 1460. On the way what I think is 2,500. It's been a little disappointing to a lot of investors because it's seemed like it was getting going and then it stopped and corrected again, started to go again. It just seems to be fighting that uptrend. And yet, from a big picture, again, stepping back and looking at it from a longer perspective, the chart looks great. I see nothing here that changes my mind that we're going to see 2,500 this year, and silver will be sympathetic to that move and see 45 to 50. And right now, again, we're in that period the last week where it's just weaker. The last couple of weeks, I guess, has been weaker again. And you hear a lot of people throwing in the towel and saying, "That's it. I give up on the precious metals." I look and I say, this is just another effort to shake out the weak hands, and I see an inverted head and shoulder. Nothing in what I see changes my conviction that we're on our way to 2,500 on gold and at least 45 on silver, maybe higher. And then we'll have a correction probably during the bust. But my long-term forecast going out to the end of the decade is that gold's going to be $10,000 or more, probably more. And silver is going to be something in excess of $300. So there's a big long bull market ahead. I just think people sometimes decide that it's supposed to move on their time horizon. Markets move on a time horizon that's not up to us, and sometimes you have to just be patient. Let me put not necessarily. Let me put it this way: the stock market is going to be much more damaging, much more punishing sell-off. I do think that gold and silver are going to have moves this summer, along with the melt-up in the stock market. So I think they will move up together to some extent. That doesn't mean they top out exactly together. Equities could top out, a month or two before gold and silver top out. I don't know. I'm not really caught up in that kind of a short-term call. I do think the bear market in stocks and the global bust will have an impact on gold and silver, so that I do think they will sell off. My guess is they're going to sell off far less than the equity market. So if the stock market goes down 70 to 80%, gold and silver might go down 30 to 40%. or less. Might even be 25. So they will definitely be relative performers compared to the equity markets. And part of that is because the central banks of the world are going to have to come in with both feet to try to stabilize things as the financial market melts down, not just stocks, but we're going to have, banking crisis, et cetera, around the world. So you're going to see a lot of money created. If people think what we saw in 2020 or between 2020 and now was a lot of money, just wait, because I think this is going to be so much more. As I say, the Fed's balance sheet could grow to something in excess of 20 trillion, might even get to 30 trillion in response to the bust. It's going to be necessary to try to stem the tide of financial meltdown. As that starts happening, I think gold and silver are going to catch a bid. So that will limit the downside, but it'll still be painful. I mean, if gold and silver sell off 25 or 30%, it's not going to feel good. And miners obviously probably sell off more than that. So it's you will have a period, might be a matter of a few months, where they correct along with stocks, but then I think they bottom much sooner than the stock market, and will start their next leg up a couple months earlier than the stock market does. Yeah, I think the story of the next cycle is going to be inflation. As I said, the response to the bust is going to be massive money, and money way times anything we've ever seen in history. So that massive money, when you overwhelm a system with money to that degree, inflation's going to be the result with a lag. It's not going to happen right away. We've already seen the money of the last 15 months has led to an inflation outbreak here. We've broken out of long-term downtrends. I think we'll dip back into a period where we actually go into deflation for the first time since the 1930s, but it won't last long. It might last a year or less. Beyond that, because of that response of money, you're going to jumpstart an inflation cycle unlike anything we've seen since the 1970s, early 80s. I'm predicting a full retrace of inflation back to the high double digits by the end of this decade as a result of that money printing. Gold and silver will respond to that big time, as will most commodities. Next cycle will be all about commodities, the metals as well as agricultural commodities as well as other materials. So, that's 2023 and beyond, but that's coming. And gold and silver will be, I think, probably at the very top of the performance list when we get into that cycle.
Hey guys, don't forget, if you're liking this video, please hit that thumbs up. We really do appreciate it. So before we get to the rest of the video, let me just share my synopsis or thoughts on what David Hunter has just said. So he's got his 2021 price target of gold and silver at $45 for silver and $2,500 for gold. And you'll see a chart that I share shortly from Gold Switzerland, who have similar price targets, slightly more bullish. I did a video the other day, what was it entitled? Silver to the Moon, something like that, where I gave my price target for gold for 2021 as $2,100 and silver $44. So I seem to be the most conservative out of this lot. But longer term, David sees beyond later this decade, $300 silver and $10,000 gold. And that's because he sees a big deflationary bust. He sees asset prices collapsing, in particular the stock market, and that central banks and governments will literally flood the system with currency, with fiat currency. And that will create significant inflation, and that's where gold and silver will do extremely well. Now, I am kind of in the David Hunter camp, kind of. Now, other deflationists, or people like that agree with David Hunter, like Brent Johnson and even Jim Rogers, So Jim Rogers was asked, are you currently buying gold and silver? Even though he still, you ask Jim Rogers, he will say that gold and silver is the best assets that he looks at the moment. And he was asked, are you buying it? He said, no, not right now. Why? Because he sees that markets are going to correct significantly and gold and silver will pull back. He believes that gold and silver will pull back, like David Hunter said here. And that's when he will be backing up the truck. Now, Jim Rogers owns a lot of gold and silver. He says that he's going to wait. Now, Brent Johnson, he says that we're going to have this also asset price bust, this asset bust, and then everyone will run to the US dollar and we'll have a spike in the US dollar. He also agrees that the US dollar is ultimately going to collapse and that you want to own gold. In fact, his synopsis is that the dollar and gold rises together. And actually, Jim Rogers thinks the same. Jim Rogers is holding US dollars. I'm holding US dollars because we think that there could be this run on the US dollar when markets do collapse. And we'll probably put the dollar into a bit of a bubble. And then, for me, and like Jim Rogers, we'll sell it. And then we'll back up the truck and we'll load up on even more gold and silver. Now, Brent just recently said at a George Gemmon event that you want to own gold, and that this monetary system that we're in isn't going to last much longer. Jeff Snyder as well said the same thing. You want to own gold, that this monetary system isn't going to last much longer. Stan Druckenmiller, he says that the US dollar will lose its reserve currency status by 2035. So he's buying a bit of a leap option there, buying quite a bit of time to be right. But you've got Jeff Gunlock, who says by 2030, by the end of this decade, the US dollar will lose its reserve currency status. Felix Zalouf says it's going to be much, much earlier than that. You got Dr. Michael Burry and Professor Richard Werner, who says 2023, we're going to see hyperinflation. Now, David Hunter kind of thinks 2023 is when we're going to see this significant inflation because of the response from government and central banks to this market crash. 2023 just seems to be a big pivotal point for me. So longer term, David sees gold and silver being much higher. Short term, but here's the thing: timing is so difficult. And I short markets, and I can tell you from experience that timing is so difficult. The market can remain irrational longer than you can remain solvent, and that's so true. And I've made mistakes and been burnt just on timing. I've been right on my outlook, just the timing has been wrong. So a lot of the inflationists, we know what the end game is. Now, we admit that the deflationists can be right in the short term, but when? I mean, the deflationists have been calling for deflation for a little bit of time now, and for the stock market to crash and bond market to go well because yields go down. We haven't yet seen that. The market has continued to be extended. But I think that they might be right in the short term. But why try to time it? Why try to get cute? There's the possibility that it doesn't happen. So if you try to time it and it doesn't happen, well, guess what? You've just missed out, and we go straight into a massive inflationary environment or hyperinflationary environment. Or you just position yourself for that end game and let what happens in the short term play out. And if you've got a bit of cash, then buy up when it's when the metals gets a bit cheaper. I don't know. Anyway, let's get to the rest of the video. All right, so here's a chart of gold versus the US 10-year real rate. Now, as we know, the real rate is continuing to go negative as the nominal 10-year yield has continued to go down. And that is a good marker for gold. And so just on this chart alone, it seems like gold is quite undervalued and has got a lot of upside room. So it's interesting that this chart really just shows two opposing bellwether indicators. And I've lent towards Lyn Alden's 1940s, that we're going to see a 1940s type scenario where interest rates are held to the floor, where we get these big spikes of CPI, and we really try to inflate away the debt, the similar debt levels between, from coming out of World War II to now. However, I do think that the stagflationary environment makes a lot of sense as well, because we know that banks traditionally are the creators of new currency, where they create loans, but they're not creating new loans going to the productive sector of the economy. And so we don't have a healthy economy. We don't have this reflation of economic growth. I just don't see it. I see stagnation. I see costs for businesses, whether it be wages due to government policy. We see the Biden administration policy of basically telling employers, increase your salary if you want to compete against our unemployed workers, our unemployed benefits. In Australia, the RBA last week just said that due to borders being closed, without the mass immigration, then we're going to see wages increase, because they admitted that mass immigration pushes down wages. So I definitely see that we're going to have a very stagnant economy. Definitely not getting that economic growth, because there's nothing going into the the productive part of the economy. There's a lot of lending going into asset speculation, whether it be property or margin debt for stocks or other assets. We do see that banks, through the central banks, buying more and more government bonds, and governments seem to have taken over the creation of currency by simply increasing deficit spending, spending directly into the economy or into people's back pockets. So we're getting a less productive economy growth, less production, less supply of goods and services, while we're getting new currency units through this fiscal, and I think that's going to continue. So this stagflationary environment definitely seems to make sense. And when you see the FOMC, their minutes suggest that the Fed's going to continue with their quantitative easing program. And so a few weeks ago, this talk of thinking about maybe raising rates and tapering, the actions have not backed that up. And this is why I keep saying, look at what they do, not what they say. And it's not just the Fed, the ECB. They've just now come out and said, well, we're going to let inflation rip, or CPI rip, above our 2% target. So we're going to copy the Fed with that. We know the ECB is calling for more monetary. No, it's not time to slow down the monetary and the fiscal. We've got to keep on going. And also here in Australia. So just last week, the RBA said that they're going to continue with their bond purchases at a rate of $4 billion a week until at least mid-November. Now, what I have not seen reported anywhere in the media or the so-called financial experts is when you actually have a look at this and what the RBA are doing. All right, so let me bring up this chart now. The ECB absorbed 85% of net Eurozone government issuance in 2020. I believe it's even higher now. And the reason why I bring this chart up while I'm talking about what the RBA is doing, so if the RBA continue to buy government bonds out to mid-November at $4 billion a week. Now, if we consider that the government forecast deficit is $100 billion, and if the RBA focuses solely on those government bonds, then guess what? That means that the RBA is buying more than 200% of net issuance. So what does that mean? It means we have a more manipulated bond market than Greece. And this is what I keep saying, the bond market's the biggest bubble. They say, listen to the bond market talks. Well, yeah, in a free market it does. But we don't have a free market. We've got central banks manipulating the bond market all around the world. Unbelievable. Unbelievable. Now, this is the chart from Gold Switzerland. They've got a price target at the end of this year, by 2021, that gold will be 3,000. And with that, if gold is 3,000, then they say silver is going to be well above $50. So it's going to break its all-time high this year. Now, time is running out for that. We're in July. Now, I did a video where I said, gold target 2,100 and silver maybe $44. We got David Hunter, $2,500 this year, $45 silver. But I'll be honest, I think gold and silver will be higher by the end of the year where it is today. I do believe that. How much higher? I don't know. Where I really see the bull market happening for gold, and I think silver will follow suit, is come January 1 next year, when the LBMA and the bullion banks have to abide by the Basel III rules. And I've got a video coming out later this week, an update on the Basel III, and I'd love to talk about it right now because there's so much, I feel like I'm going to share or shine a light on some of the shenanigans that are happening in the gold and silver market, or in the gold market in particular, and how that might be set free somewhat next year and the year after. So I think if you've got a time horizon of at least a year, to be honest, probably more, a couple of years in the precious metals market, I think you'll do very well in precious metals. Now, from a fundamental point of view, this is Keith Neumeyer from First Majestic. There's a major silver shortage. Very few discoveries or new mines are being built. The new Green Deal will be a major buyer of silver, of which there is a short supply, of making it a perfect storm for silver prices. And I do agree. Now, I've got 3 what I would call tier 1 discoveries here in Australia of silver explorers. Definitely 2 of them you'd consider tier 1. I still consider the third one tier 1 as well. And I'm quite excited about those. But outside of that, there's not a lot of new discoveries of silver where it could be a standalone silver mine. Yeah, sure, as a byproduct of maybe a copper or a gold mine or something. But as a standalone silver mine, there's not many there. Now, sure, if the price of silver goes up significantly, then that makes some of these smaller discoveries, these smaller explorers, maybe viable as a business. But from a fundamental point of view, we're going to see with the electrification of the economy moving forward, whether we like it or not. I definitely don't like it, but that is going to be a fundamental driver from an industrial point of view of silver and those other commodities, which are going to be bullish over the long term. But we do know that it's really investment demand that drives the price of silver. And so whether it's the fundamentals from the industrial side of things, or whether it's the investment demand driven because of the monetary insanity that's going on, I definitely think that gold and silver, especially silver, I'm very bullish on that moving forward. Even though I do agree with David Hunter that if we see a market crash and a lot of debt being blown up, that gold and silver can see a bit of a trace back as well. And speaking of the stock market, total margin debt, well, .com bubble, 450 billion, Great Recession, 400 billion. Now 850 billion. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis. And he would know. He would know. And so, yep, I do see a stock market crash. I don't know if it's going to be 80%. I got no idea how much it's going to be, because central banks, I believe, will come in and turn the printing presses on to do whatever they can. And governments will do the same. They'll back it up. This is not going to be a fun decade for most people. So anyway, what do you guys think? Do you think gold and silver is going to be higher later this year? Do you think gold and silver later this decade could be $310,000? Don't forget, if you like this video, please hit that like button. Give us a thumbs up. Really do appreciate that. Anyway, guys, take care, and I'll see you again on another episode of Finance Uncut.